Time to brighten your day with our pro traders, Alan Knuckman, the chief market strategist of BullseyeOption.com, and Phil Flynn, a Fox Business News contributor. Get ready, guys, for round number one. Rate it. The Fed's recent interest rate hike was the largest since 1994. How would you grade the Fed, and what will it mean for the macro market?
Wow, I have so much to say. Number one, people need to relax. They've raised rates, and now we're at a whopping 1.75%. From essentially free money, which where we at, and everybody's disappointed about that. But if you look at the futures markets, they're telling us we're going to top out at about 3.5%, 4%, and then we're going to hold that all the way through 2030. So this is still historically super low. You know, I'm not here to judge the Fed's actions. They're going to do what they're going to do, and that's more of a parlor game. My main concern is how the market reacts. And unfortunately, the markets have not been able to hold these gains. It's just nothing but negativity, even though rates are at a historically low level. We were at 20% in 1980.
Well, they're a little bit nervous, of course, because a lot of people think the Fed was behind the curve. Inflation's at a 40-year high. And heck, they're really afraid because there's so many comparisons to what we're seeing now versus the stagflation of the 1970s. They're really afraid that leisure suits may be coming back. I can assure you that's not going to happen. You know, the bigger issue for I'm sorry, maybe they will. But, probably the bigger issue for the market right now, of course, is whether the Fed is going to stop where Alan said they were. There are some experts out there saying that rates might have to get to 6% to get back to normal and get ahead of inflation. So that's going to be the bigger issue longer term, but short term, there's going to be some good value in some stocks. So don't throw the baby out with the bathwater, but that doesn't mean that rates couldn't go higher than the Fed is saying right now.
The markets are telling us they stop at 3.5%, at 4%.
Right.
Actually decline back up to 3.5% as we get out to 2024 and 25 and 26.
Of course, the market was also telling the Fed a few years ago that inflation was going to stay low, and they were wrong about that as well. So
wait, the Fed doesn't determine the markets are telling us, the futures markets, not the Fed.
Right, and the futures market had it wrong, a couple of months ago. So there you go.
Round number two, lumber slumber. It was not that long ago. Those lumber prices were way up there at $1,500. Since then, those prices are down to around $500. But there is a sriracha sauce shortage. So what do you think will be the next commodity to go from hot to not?
If you look at the lumber market, that was a forerunner of the potential run-up in overall commodities. And there were a lot of reasons for it, right? We had this building boom going on. We had these sanctions against Canada on certain grades of lumber. But, I think what you're seeing here on the sell-off is a perfect example of high prices curing high prices. Not only do you have the Fed raising interest rates, which should slow the building boom just a bit. In fact, it already has. But also you've seen builders go to alternatives. So instead of using wood 2x4s, they move to steel or aluminum or something like that. So you do see that overall. Now, we do think that lumber prices are going to continue to go down for a bit. They'll eventually bottom, but they probably won't bottom till we get a better feel on a couple of construction numbers that are coming out. New housing starts is something to watch. If they start picking up again, they're going in the wrong direction. They start trending back up, then that might be the time to step back in the lumber.
Bill, you said what I wanted to hear, that lumber was a barometer for the breakout on the upside. It had traded between 200 and 400 for a decade before that breakout. So we may come back to that breakout. But that's the idea, that prices can come down, and they can come down really fast as well. So, let's not ignore that happens now, and that's a great example. My commodity to go from hot to not is sugar. Sugar's rallied from 10 to 20, and forever my whole trading life, sugar has been dirt cheap. And so what's interesting here is, and I'm not calling for a top in energy, but what's interesting here is sugar has fallen a little bit because the demand for ethanol is going to slow. Sugar beets are used a lot in ethanol. That could slow as crude prices, if and when crude prices do back off just a bit.
Round three, Cash Kings. Barclays put out a list of 25 S&P 500 companies with expected large cash reserves. Which Cash King stock will be on your royal list?
The stock that I like on their list is Las Vegas Sands. The house always wins. And this was a $65 stock in 2021. And right now it's trading at 30. It's been between 30 and 50 here for the last year of trade. We're down on this bottom base. So I like the risk reward. Again, it's not about tomorrow. It's not about next week. week. I'm talking about the next months and the next 6 months going into, I'm looking at January options, looking to see how these markets can stabilize and recover from here.
And it's not necessarily always cash on hand is what you want to look for. You want to look at revenue, right? Exactly. Cash flow. Exactly. And that's why I like Cenovus Energy. That's a Canadian oil stock. It's very low right now, but they're printing cash like crazy right now.
Here's your bonus round question for today. How long did the longest bear market run last? Was it 5 years, 3 years, or 2 years?
I believe it's 5 years.
It didn't happen in my lifetime, I don't think. I'm gonna go with 3. I'm gonna pick the middle.
Alan, that bear market did not happen in your lifetime. It ended in March of 1942 and lasted 5 years. Phil is this week's winner. Great job as always. Go to businessfirstam.com for where to see our show on TV.